Welcome to the deep dive. Today, we're really digging into something fundamental. Why does the whole global financial system feel, well, kind of broken, always creating more debt? And maybe more importantly, what can you, the average person, actually do about it?
Okay, let's unpack this. We're leaning a lot on analysis from macro expert Lyn Alden. Her view is pretty interesting. Money isn't just economics, it's technology. And our current system, it's basically built on tech compromises from way back in the 19th century.
Yeah, that's really the core insight. It's not just a few bad decisions here and there. The actual plumbing of the system is the issue. Money is, you could say, structurally flawed on a global scale. Now, if you're listening in, say, the US or Europe, you feel inflation, sure, but the deeper problems might seem a bit abstract.
Right, it's noticeable, but maybe not catastrophic day to day for most.
Exactly. But in large parts of the world, these aren't abstract problems at all. They are very real, very immediate. Take that example from the sources. Somewhere like Egypt. The money supply there, it often grows by 20%, sometimes more, every single year.
Wow, 20%. Yeah. So if you live there, you're basically running on a financial treadmill just to stay still.
Yeah.
Your savings, your wages, they're constantly being diluted.
Mhm.
If you don't somehow get a 20% raise every year,
Mhm.
you are actively getting poorer in real terms.
That makes total sense then why someone in Cairo might just decide, forget the banks, I'm stuffing US dollars under the mattress, even now. But looking bigger picture, it's even wilder. The sources point out we have over 160 different currencies globally,
Right.
and most of them are kind of like arcade tokens. They only really work in one specific arcade.
That's a great analogy. Outside their own country's borders, the actual usefulness, the moneyness of something like the Norwegian krone or the Egyptian pound just vanishes.
Hmm.
They only have value because the local government says you must accept this. So the big question becomes, how did we end up with this fragmented world, like 160 competing little money monopolies?
Okay, so where do we start tracing that back?
Well, according to Alden's analysis, you have to go back to technology.
Yeah.
And what's fascinating here is the single most important piece of monetary tech in the last couple of centuries.
Uh,
It probably isn't the computer. It's not the internet.
Okay.
It's arguably the telegraph back in the mid-1800s.
The telegraph. Really? How does a communication tool become a money tool? That seems like a leap. Did things break immediately?
No, it wasn't immediate, more like a slow grinding pressure. See, suddenly information, the order to pay someone, knowing where the money is, could travel at the speed of light,
Oh,
basically.
instantaneous communication.
But the actual settlement, moving the physical gold bars or silver across oceans or continents, that was still incredibly slow. Think ships, trains, expensive too.
Ah, I see. So there's this huge gap opening up. Information is instant, but the actual money is slow.
Exactly, a massive speed gap. And because you couldn't physically move the metal fast enough to keep up with the
I
information,
had to rely on something else.
yes, that gap forced the system onto two pillars, credit and centralization. If you can't move the real money fast enough, you have to move the promise of money, the IOU.
Okay.
And that necessity, that need for promises, led directly to the spread of fractional reserve banking, FRB.
Right, fractional reserve,
Right.
where the bank holds only a fraction of deposits and lends out the rest.
Precisely.
Yeah.
And the bank ends up making two promises that fundamentally can't keep at the same time.
Yeah.
They promise depositors you can get your money back anytime you want,
Down deposits.
while also promising borrowers here's a long-term loan, meaning that same money isn't actually in the vault, it's tied up,
So it's inherently leveraged.
highly leveraged. The sources mention leverage ratios of like 20 to 1. Even back in 1875, that builds fragility right into the core of the system.
Okay, so if the whole system is built on this shaky, high leverage game, and eventually someone panics and wants their money back,
Yeah,
the music stops. Who cleans up the mess?
that's where the central bank comes in.
The lender of last resort.
Exactly. They were set up partly to manage those inevitable fractional reserve banking crises, to provide liquidity, bail out banks when things went wrong.
Okay, that's one reason.
But there's a second reason, maybe even more important for governments. Central banks became the perfect tool for funding wars.
How so?
Well, trying to raise taxes directly to pay for a big war, that's politically dangerous. People revolt.
Right, unpopular.
But if the government can borrow from its own central bank, which can essentially create money, well, it leads to currency dilution, inflation. It's a much quieter, sneakier way to tax the population, less obvious, less likely to cause riots. And it's this constant pressure stemming from that original telegraph speed gap, the pressure to use credit, to centralize, to inflate. That's what eventually blew up the old monetary systems.
Like the classical gold standard?
Yep, and Bretton Woods after World War II. Both buckled under the weight of that centralized credit-based structure.
Okay, so that brings us closer to today. Bretton Woods collapses in 1971. Nixon closes the gold window. Here's where it gets really interesting. The U.S. dollar is suddenly floating, not backed by gold. How did it stay on top globally?
It needed a new anchor. Not gold, but something else the world absolutely needed.
Oil.
Oil. That's the Eurodollar, or maybe more accurately, the petrodollar system.
Yeah.
After 71, the U.S. made some crucial deals. The most famous one is probably the 1974 agreement with Saudi Arabia.
Right, I've heard of this.
That deal essentially locked two things in place. One, global oil had to be priced in U.S. dollars. No exceptions.
Okay, creates dollar demand right there.
Huge demand. And two, maybe even more critical, the profits Saudi Arabia and other OPEC nations made from selling that oil. Those surplus dollars, called petrodollars, had to be recycled back into buying U.S. Treasury bonds,
Yeah.
U.S. government debt.
Wow, so they sell oil for dollars, then use those dollars to lend money back to the U.S. government.
Exactly. It creates this guaranteed constant loop of external demand for both U.S. dollars and U.S. debt. It basically underwrites the whole system.
And that setup, as the sources describe it, creates this really stark division in the world, like a two-tiered system.
Absolutely. You've got Tier 1, the U.S. It gets to print the world's reserve currency, its own liability. It benefits massively from what's called seigniorage, basically, the profit made from creating money.
Yeah.
Like the U.S. charges the rest of the world a tiny fee for using its dollars.
Okay, so the U.S. is in a privileged position.
Hugely privileged. Then you have Tier 2.
Yeah.
Pretty much everyone else, but especially emerging markets. They don't get to print dollars. They have to earn them or borrow them.
And borrow them they do.
Right. They take on huge amounts of debt denominated in U.S. dollars. So when U.S. monetary policy changes, like when the Fed raises interest rates, the value of those dollar debts suddenly surges for those countries.
Making them much harder to repay.
Exactly. It leads to these incredibly painful boom-bust cycles in developing nations. Volatility gets exported from the center to the periphery. And then organizations like the IMF often step in.
Offering dollar loans, but with strings attached.
Very tight strings, often forcing governments into really harsh austerity measures, currency devaluations, things that can cause deep recessions locally, all to ensure those external dollar debts get serviced.
Meanwhile, back in the developed world, like the U.S. or Europe, the problem isn't usually those violent boom-bust cycles. It's more subtle.
Yeah, it's more of a slow, steady bleed. Inflation, yes, but also this relentless accumulation of debt at the government level.
Right.
Every crisis. Think the 2008 housing bust, the pandemic response, the long-tail cost of things like the war on terror.
Right.
Massive amounts of debt, often originally private debt, gets shifted onto the public balance sheet. The national debt just keeps ratcheting up.
And that has political consequences too, doesn't it?
Huge ones, because the real cost of all this deficit spending and currency creation is delayed. It's pushed out into the future. The inflation might be felt now, but the true debt burden, that's for later generations.
Which makes it hard to hold anyone accountable.
Exactly. It fuels intense political polarization because the people making the spending decisions today often aren't around to face the consequences decades later. You can't easily pin the blame, so everyone just blames the other side.
And if you follow this trend of centralization and sort of opaque funding, the logical endpoint seems to be what people are talking about now. Central bank, digital currencies, CBDCs.
That seems to be the direction many central banks are exploring. A CBDC could, in theory, give the state complete visibility and control over every single transaction. No more cash, no more financial privacy, just a direct government ledger for everything.
Okay, so that paints a pretty stark picture. Systemic dilution, growing centralization, the potential for total control with CBDCs. Given all that, what can the average person actually do? How do you protect yourself?
This raises an important question.
Yeah.
How do you break out of these currency silos, these systems that often trap people in money that's constantly losing value, especially if you don't have access to sophisticated financial tools?
We need some kind of personal defense strategy, right?
Well, the sources we looked at, particularly Alden's work, suggest the potential answer lies again in technology. But this time, it's decentralized digital tech.
You mean things like Bitcoin?
Exactly. The argument is that something like Bitcoin, which emerged in 2009, finally offers a way to do fast digital settlement that doesn't require a central intermediary.
So it closes that original speed gap from the telegraph era.
Potentially, yes. It allows value transfer at the speed of information, but without needing centralized credit systems or a lender of last resort like a central bank. It's peer-to-peer. And for people facing really high inflation or maybe living under authoritarian regimes, this isn't just theoretical. It offers a genuine choice of money.
Okay, how does that choice play out practically? What can someone actually use it for?
The sources highlight three key practical benefits people are using today. First is portability and self-custody.
Meaning you can take it with you.
Yeah. You could secure potentially vast amounts of value just by memorizing, say, 12 words your recovery phrase. Think about what that means. You can cross a border with nothing but the clothes on your back and those words in your head, and you effectively bring your wealth with you. It bypasses capital controls, government surveillance at borders. It's like infinite value density, a powerful defense against sovereign risk if you have to leave suddenly.
Okay, that's huge for certain situations. What else?
Second is payments.
Yeah.
Especially cross-border payments that bypass the old system. Think about a graphic designer, maybe in Nigeria or Argentina, dealing with high local inflation and strict currency controls.
Right.
They can get paid by a client in the US or Europe directly in something like Bitcoin, or even a US dollar stablecoin peer-to-peer. They skip the local banking system, avoid forced currency conversions at terrible official rates. They get paid in a harder currency immediately.
So it lets them operate outside their local failing system to some extent?
Exactly. And that leads to the third point, stablecoins. Things pegged to the US dollar, for instance. For millions of people in countries with unstable currencies, stablecoins are effectively giving them access to dollars.
Like a digital dollar they can hold themselves.
Pretty much. It functions like an offshore bank account for the middle class.
Yeah.
It lets ordinary people easily opt out of holding their savings in a currency that's constantly being devalued by their own government.
That really reframes how we should think about this technology, doesn't it? It's not just speculation.
No, not at all. Though speculation gets the headlines.
It's more like a portable, self-controlled optionality asset. It gives you the option to step outside the state-controlled financial ledger if you need to. It brings competition back to money itself.
Precisely. Now, a crucial piece of advice, especially for listeners maybe in the US or Europe who aren't facing immediate financial collapse or fleeing a regime.
Yeah.
You absolutely have to understand how powerful and entrenched the existing dollar system is. The network effect is massive. We're talking hundreds of trillions of dollars flowing through it.
So change won't happen overnight.
Definitely not. While the need for alternatives is glowing because the current system has these structural flaws we've discussed, the dollar is still the deepest, most liquid market in the world. Its inertia is huge. So managing your expectations about the timing of any major shift is really key if you want to preserve your wealth. Don't get swept up in hype cycles and get wrecked.
Okay, so practical steps might include
Diversification into different kinds of assets, certainly including hard assets. Thinking about self-custody for some portion of long-term savings to remove that counterparty risk we talked about with banks. And just understanding the long game. The pressures are building, the trend seems clear, but structural change takes time.
So what does this all mean? When we boil it down the way our money is structured, it really dictates a lot what's politically possible, how much economic freedom individuals have, whether your savings hold their value.
Yeah. The problems we feel today, the inflation, the debt, the political tension, they're largely symptoms. Symptoms of a financial system that was built around a specific technological limitation centuries ago and then got kind of locked in place by political centralization and, frankly, the convenience of opaque taxation through inflation.
It seems like we're genuinely at a fork in the road then.
It really does feel that way. One path is continued, maybe even accelerated centralization, potentially leading to CBDCs, more surveillance, more state control over economic life.
And the other path?
The other path uses these new decentralized cryptographic technologies, things like Bitcoin.
Yeah.
That path offers the potential to push back against centralization, to reintroduce competition into money itself. It gives individuals tools to opt out, to choose.
Which leads to a pretty provocative final thought.
If governments have historically relied on debasing the currency inflation as a sort of hidden, opaque tax,
Right, the stealth tax.
what happens to their power, their political accountability, when potentially millions of people can just choose to opt out of that tax entirely? By holding their value in a hard, decentralized form of money, the government can't easily control or inflate away.
What does happen then?
That's something for you to mull over until our next